Stocks resume their climb after a shaky start with the mid-caps in the lead. Consumer durables and IT are the prominent gainers, while energy and financials drag.
Hindustan Unilever has a slow-moving quarter with no volume growth and moderation in consumption seen ahead, but Pidilite beats estimates on volume growth, riding on strong traction in its B2B business.
Coforge and Persistent Systems log in strong growth and guide for continued growth momentum in the foreseeable future on the back of a strong order pipeline. Both stocks jump.
L&T's JV with Spain's Navanisha has been disqualified from the 70,000 crore rupee P-75 submarine project for failing to meet technical criteria. Sources tell CNBC-TV18 that Mazgaon Dock and ThyssenKrupp Marine are the only qualifying bidders left, but a final decision is awaited.
Reliance Industries inks a memorandum of understanding with the Maharashtra government to invest over 3 lakh crore rupees in the state across sectors including new energy, retail, hospitality and high-tech manufacturing, with a potential to generate 3 lakh jobs. You're watching us here on Halftime Report on CNBC-TV18. I'm Manglam Malu. Joining me today is Surabhi Upadhyay. We're seeing some sort of recovery from the lows, but there is a lid kept on the gains in the market. The good part is that the broader market's feeling a little better today. It's a Thursday, it's weekly options expiry. So who's to say where the market goes in the second half? Hi, Surabhi. Welcome to the show.
Hi, Manglam. Yeah, thank you for that. And I guess you just said the most important cue. Given that it's Thursday, this can swing anyway, right? But for the better part of this week, at least, the market has protected the downside. I mean, that range hasn't broken around the 23,000, 46, 47 mark. And the bulls will hope that they can actually try and build on this. But let's see, we have that expiry to go over. Just very quickly, I mean, today's sort of trends, mid-caps are outperforming today, and we haven't seen that in a while. After the drubbing that they got yesterday, there's a good amount of recovery coming in. There are a couple of interesting result reactions, some positive cues, particularly on mid-cap IT, and we'll talk about that as we go forward. So stocks like Coforge, Persistent Systems, they've got some amount of enthusiasm and cheer going as far as the mid-cap screen is concerned. But on the large-cap screen, just to quickly round this up, 62 points higher. And the gainers are cutting across sectoral lines. I mean, you have some names from FMCG, you have some names from commodities like JSW Steel right now, shooting higher. There is Coal India, there's ITC, there's Cipla, there's IndusInd Bank, there's Tata Steel. So it's really across the board in terms of gainers. But yes, the caveat is the bank Nifty overall is still underperforming. There's still some red on that one index, Manglam.
And that is courtesy HDFC Bank. We'll just keep an eye out on that. Yesterday was HDFC Bank along with Infosys that led the recovery. Today, IT is keeping up its end of the bet, whereas banks have faltered. So HDFC has moved to the low point of trade, even as Infosys has moved higher. But a lot of earnings to track and a lot of earnings action to keep an eye out on as well. And first on our radar is Rosary Biotech. The first management on the show reported a mixed set of numbers despite softer domestic market conditions. So to discuss this and more, we are joined by Sunil Chari, who's the co-founder and managing director at Rosary Biotech. Thanks a lot, Sunil, for joining in. And, it was the quarter that it was. You also said that the EBITDA margins were also lower because of ongoing investments in future initiatives. If you could give us a sense on what those investments are, how much they amount to, and X of those investments, how did the performance do? What is the kind of growth that you anticipate in the future?
The new initiatives we have increased the team strength in our Rosary professional business, which is the cleaning, hygiene and disinfection, which we could say semi B2C kind of business. We have also increased the team substantially there. I think we have added about 100 people in sales there. We have increased the spend on exhibition expenses. Travel has increased a lot. And if you see our 9-month gross margin, it is 469 crores against 403 with the corresponding 9 months of the last year. Exports have done significantly well. We are at 156 crores. It is the highest ever exports. At 512 crores is the highest ever quarterly revenue ever in the history of Rosary Biotech. So I think we have done well. Even in the 9 months, if we compare exports, it's about 405 crores compared to 317 in the previous year 9 months. In terms of other initiatives, there is increase in R&D. The R&D team has been doubled. So we are going gung-ho on, spending for the future. And we also have the new capex, which we think will come up in line in March, end of this quarter or April in the first quarter of next year.
Okay, so Mr. Chari, let's break this down further and go step by step. We'll come to the expansion and the capex in a bit. But let's talk about, the demand trends that you've seen, because apparently in the domestic market, you've seen softness and the export market is doing better for you. How prolonged will this softer patch be? What can you expect? Because profitability is down year on year, and there's been a lot of pressure on your EBITDA margins as well. So let's talk about the domestic market. What's going on, and how prolonged will this weak patch be?
I think we are seeing a small pickup already in the domestic market. So this quarter we should see, better numbers in the domestic market. Export continues to be strong for us. In terms of, I would again reiterate that we should look at our gross margins now, which are 469 crores in this year compared to 403 crores last year. The fact that we spend more on growing for the future puts down the EBITDA a little.
Just to update us, what is your domestic versus exports mix right now in the revenue? And since exports are doing much better, those markets are growing much better, where will you be by the end of the year? And if you could tell us, what is the average growth rate across your export markets, across the main business verticals?
We were at 23%, averaging in the previous quarters and the previous year. And now we are nearly 30% of our sales is exports. So we believe in, earning in dollars and spending in rupees now.
And growing at what clip? I'm asking, these are different geographies, different product lines, but ballpark, what's the clip at which the export business is growing?
Export business, year on year, we were at 317 crores last year in the first 9 months, and now we are at 405 crores. If you see last quarter, quarter 2 of this financial year, we were at 130 crores, and now we are at 156 crores. So export is growing at a phenomenal rate.
All right, and you said you expect some recovery in the domestic business in the second quarter. Let's talk about not just the fourth quarter, which is coming by, but the next couple of years with the kind of investments that you are making. What is a sustainable growth path that you're looking at for the company in terms of revenue? What would the margins entail when the business grows at the clip it does? Because new capacities will be coming on stream. You will be increasing your utilization there as well. Do we see it growing above this 13% that you've guided for this year? What could the number be?
I would be cautiously optimistic for the coming quarters and the coming years. Let us see how it pans out. But we see good opportunities for us to grow, both in terms of EBITDA as amount, because we're focusing as EBITDA as amount instead of EBITDA as a percentage, and also the top line. We should see healthy growth in the coming quarters.
How do you define healthy? How do you define healthy, Mr. Chari?
I think if you see when we came during our IPO, we were a 600 crore company with a 80 crore EBITDA. Today, we are now, nearly 260 crores EBITDA. So we've grown well. In the next 4 years, 3-4 years, we should hope to emulate, what we've done or do better than was in the past 4 years.
All right, so we'll take you up on that as the business grows along. Just final question, animal health, that has been one of your pun unintended pet projects. How fast do you expect this to scale up, and are you looking at any sort of demerger here at some point?
No, we are bullish on our animal health nutrition prospects. There has been overcapacity in the Indian market, in the Indian poultry sector. But we have added new people in R&D. We have added new products in our R&D, and we are sure that this will grow very well in the future.
Okay, all right, Mr. Chari, we will leave it on that note. Thank you very much for joining in and giving us a heads up on the business trends and what you're expecting ahead in this year. We'll take a break right now, come back on the other side, and we'll focus on the F-note trends at midday.
Welcome back. Let's just take a look at the markets. It's in the higher end of the range today, but the highs of the Nifty have been curtailed to around that 23,250 odd mark itself. It's just 20 points away from there. The only fly in the ointment is the Nifty Bank. So if you just take a look at the FNO setup at midday, because it's a Thursday, all the more important. The Nifty is holding well. Nifty Bank is lower. It's actually the Nifty IT index which is supporting it with a gain of almost 2.5 odd %. And the broader market health is a lot better, and that typically is better when the street believes that, maybe we have seen some support at the lower levels itself. For the last two trading sessions, the Nifty has been bouncing off from levels just below that 23,000 mark. So if you look at the advanced decline, that tells you the story of at least today, after a big, gash that we saw in the mid-cap and the small-cap indices in the earlier part of the week, now they're seeing some bit of a bounce back, and it's been led not just by IT. The sector of the day clearly has to be mid-cap IT. We have Coforge doing well, Persistent doing well, after having seen a big decline yesterday on Persistent itself. Oracle Financial, or even Birlasoft and Cyient, all of them pulling their weight for the mid-cap end of things. Now, at 23,200 is where, most of the straddles are placed, which is a call and a put together. So 23,200 call has a premium of 9 rupees. If you pull up, 23,200 put has a premium of 9 rupees. Pull up the 23,200 call, that has a premium of almost 44 odd rupees. You sell both of them, you are playing for a premium of 50 rupees and a range of 23,150 to 23,250 for expiry. If the market was to, stick around this range, these option writers would make a lot of money. Beyond and above this range, maybe we could see a move on either side in a big manner. Just keep an eye out on a couple of stocks. I'm watching out for NMDC with the kind of up move that we've seen and the open interest jump. It may enter FNO band today, so just watch out for that.
Okay, all right. So those are the cues and those are the interesting stocks to keep an eye out on. Now let's move on and dive into the Growth Code, an initiative by Grow and CNBC-TV18, which offers valuable insights and strategies to help you make well-informed trading decisions. This week, CNBC-TV18's Nigel D'Souza interviewed pro trader Rajesh Baheti, Managing Director, Cross Seas Capital Services, and asked him about risk management practices for algo trading.
Well, what kind of risk management practices should retail investors adopt when using algo trading strategies?
So the main thing is, obviously, you've got to define what will be your capital risk at risk per trade. That's the fundamental core of any trading principle, that you don't put all your capital at risk at once. Because in trading, because it's a leveraged trade, there is a chance that your entire capital can get wiped out. We've seen options go from 100 to 0. And the lure of the option is that it can also go from 1 to 100 or 10 to 1,000. So that's the reason people get into it. But if you get into it at the wrong time, you don't use your capital wisely, that 100 can also, 1,000 can go to 0. So the first principle of algorithmic trading, or any trading, would be to allocate smaller bits of capital per strategy to make sure that you're still in the market, irrespective of what the outcome of that particular strategy is. So if you look at most algorithms, they will definitely be having a stop loss, which either a particular investor can set for himself, or these are preset. So in that sense, algorithmic trading actually makes trading safer for you because of these pre-coded stop losses, and beyond a certain point, you will just be stopped out and no more trades will take place. So from that point of view, it's a better risk management tool than, pure trading on your gut, because sometimes then you will get emotionally invested in a trade and not book losses when you ideally ought to be booking losses. So from that point of view, I think it's a good risk management tool.
Welcome back. Look at the mid-cap market take off. It's a big move, almost 1,000 points on the mid-cap index. Now it's a near 2% increase, and it's a really healthy advance decline ratio that we're looking at after a long time. 1,600 stocks advancing, about 800 stocks declining. I just want to call out two spaces, where there's a full-on sector move. One is EMS. After the drubbing that EMS stocks got earlier this week, this is a day of a lot of recovery, and it's across the board. You can look at Dixon, Amber, PG Electroplast, Across the board moves coming in. Even Keynes is up about 4-5% higher. And the other is this pack, which is the mid-cap IT pack. Persistent, Coforge, Oracle, Birlasoft, you name it, Zensar, and all of these stocks are up and about. So EMS players as well as mid-cap IT players, that's where the bulk of the buying is. However, earnings as always. So let's talk about some more numbers that we're watching out for today. And United Spirits is going to be the one that's going to be on our radar as well. Manglam, what are you expecting?
A good quarter. That's what the price is telling you. That's what the street is telling you. And that's what, the quarter is telling you as well. And by quarter, I mean the financial quarter and not the other
3
quarter.
months.
Yeah.
Ending.
Yes. So why is that? Because it is the festive and the wedding season. The stocks moved to the high point of trade. There was the policy boost that came from Mahindra as well. So put all of these things together. What is it that you're expecting? You're expecting a 12.5% revenue growth. This is X of excise that we're looking at for United Spirits this time around. 3378 crores on the top line is what we are penciling in. This compares with around 3,000 crores the same time last year as well. EBITDA on the back of a better festive season, wedding season, and the policy boost in Andhra Pradesh that we alluded to grows 22%. We're looking at a number at 594 crores. Margins improve by about 140 basis points, and the net profit too increases in mid-teens itself. Why is it that the EBITDA moves faster than the revenue? Because Prestige and above, which is the business which the company is focusing on, is likely to do about 9 to 10% volume growth, 14 to 15% revenue growth. The 400-500 basis points push comes in from the policy favorable policy in Andhra. Popular, not a business that the company's been focusing on as much, grows anywhere between 2 to 4% in terms of revenue and volumes put together. Margins, as a result of which, will improve on higher sales and improved product mix, and there's been moderation in glass and stability in ENA as well. The key to track would be, the commentary on fourth quarter demand, outlook on new categories, and more importantly, the reason why the stock fell 10% off its highs was because Hina Nagarajan announced her transition and she'll move into Diageo Global, whereas Praveen Someshwar will join in. So the leadership transition is something that the street will definitely keep an eye out on. But for now, the underlying macros favor United Spirits, and that explains why the street is expecting a good quarter.
Ending December on a high.
Ending December on a high.
Okay, that's United Spirits and stocks actually at the day's high as well. We'll take a break, come back with more on halftime report, including what powered Pidilite's numbers. Great numbers, stock is holding up. We get you snippets from the management commentary.
Welcome back. You're watching us here on Halftime Report on CNBC-TV18. What we're looking at right now is the stock of Pidilite holding well in today's trading session, even though, the broader markets are doing a lot better. In Pidilite, what was a tough quarter, the company went ahead and did about 7% volume growth in their consumer business and 21% in their business-to-business vertical as well. So we spoke with the management. I spoke with Sudhanshu Vats, who takes over as the MD in FY26, and the obvious question was, in a weak consumer environment, what is it that drove their double-digit revenue growth? The company spoke about the drivers and, more importantly, the outlook for the very near future as well. Hear him out.
We continued our investment behind brands and distribution. If you remember last quarter, I think we began the journey to consumerize our brand Roff, which is a tile adhesive brand, in a big way. You would have seen it on Kabaddi, you would have seen the advertisements otherwise as well, and they were very well received. Our investments on distribution continued, whether it is the width of distribution or depth of distribution. Our investments behind Pidilite Ki Duniya, which is our rural flagship stores, grew. We added close to 1,000 and 1,200 Pidilite Ki Duniya in last quarter. We therefore took the number over 16,000, and our unique build outlets, which is the width of our distribution, crossed the milestone of 600,000 outlets in the last quarter. Our investments behind our supply chain, our growing agility on digital, which is our digital app, which you are aware of, Genie, also crossed a milestone of above 35% of all our sales coming on Genie in the last quarter.
We take that point, and congratulations on being able to do that. But just to further on that point, you attributed a lot of the growth to your increase in distribution, in innovation, as well as some of the premiumization that we saw in Fevicol as well. If you could give us a sense of organically what was the growth and how much was the incremental growth because of your increase in distribution, if you could break that number up for us. And also give us a sense of how much more did you spend on ads as against same time last quarter?
So we did pick up our spends on ad, Mangalam. But having said that, I think if you remember our ANSPs, if you look at our historic ANSPs, in the quarter that went by, we were at the higher end of our historic numbers, close to about 3.7%. Our ANSPs tend to be around 4, between 3 to 4%. So we've adequately spent on that. I think the incremental growth from what our expansion drive is and what our original pieces is, unfortunately, I will not be able to share the breakup of that, but I can assure you that the growth on core business, which we've always maintained, was also good. The growth on core business was in middle to, strong middle single digit. But the growth on our growth businesses, if you remember, we classify our businesses into core, growth, and pioneer. On growth, we were able to deliver high teens to mid-teens growth in our growth business. And I think that's what has helped us as we move forward.
Have you seen a change in consumer sentiment from the third quarter up until now?
So the consumer demand, Mangalam, as you would hear from multiple people, tends to remain a little soft. Having said that, I think what we need to do as companies and what Pidilite is doing is to identify pockets and segments and continue to build and strengthen the portfolio to be able to address all of India. And the good news is that there are pockets where there is enough growth still. There are pockets where there is an issue with growth. So I think what we continue to do is to continue to strengthen our portfolio, build areas of pockets where we could grow faster. And also the good news for us as a company is we've got a balance between B2C and B2B. And as you would have seen from our numbers, our B2B segment delivered a 21.7% underlying volume growth in this quarter.
And that was what my next question was on B2B business, because consumer sentiment weak, you did about 7%, and weak sentiment, well, your target is close to around double digit, but B2B made up for that with a 21% growth. How sustainable is this growth that you're seeing in B2B?
So B2B growths have been good. Actually, so if you were to look at our last 6 to 8 quarters on B2B growth, we've been delivering strong double-digit, arguably high teens growth in B2B. As the momentum on infrastructure continues, we continue to remain very positive on B2B growths moving ahead.
So high teens is what one can expect. At what point do you expect the consumer sentiment to turn? Because, everyone we've been speaking to is medium to long-term bullish on India, but near-term is relatively soft. No one's been able to pinpoint, the key drivers for consumer sentiment in the very near term. If you could give us a sense on when do you expect it to turn? And once that turns, with all the work that you've done, how much higher can you grow from what you're already doing?
So Mangalam, I think it is difficult to predict at specific time. But what I can tell you is what we are very eagerly looking forward to is therefore how the monsoon which went by, which is a good monsoon, begins to play out in rural demand in a positive way. There is a little bit of uptick already coming. So will that be growing further? I think that's one piece. The second piece is as the new budget comes in, we are very hopeful of the finance minister giving more money in the hands of Indian consumer. And I think if that happens, I think there could be a ripple effect of that onto growth in consumer sentiment and consumer demand. So I think these two are positive factors we are watching out for and seeing how they play out as we go forward.
The paint business, you guys have been pretty mum about that. Could you give us an update here?
Mangalam, we've always maintained, and Bharat has maintained that categorically, that I think we've got to give it a little bit more time. We will come back to you with how we are doing. Because in the initial period, with the strength of our distribution and the initial trials which will happen, there could be an unusual exuberance which we don't want to share. All I can tell you is we are making steady progress. We have expanded from 3 states to 5 states. We continue to make good progress, and we will share a lot more in detail in the next 3 to 6 months.
Sudhanshu, AkzoNobel is on the block. Are you interested?
See, Mangalam, we keep looking at opportunities from time to time. Pidilite is a company which has always been looking at opportunities. So we will continue to look at opportunities. On this specific case, there is nothing for me to share at this moment.
You've looked at it, I'm sure.
No, we keep looking at opportunities from time to time. So I think, so therefore, but there is nothing for me to share at this moment.
Do you like the asset?
So as I always maintain, we keep looking at opportunities. We will evaluate how they fit into our portfolio, what is the right price at which we should look at that opportunity, and therefore what is in it for us. So like any other opportunity, we will continue to look at this opportunity as well, but there is nothing for us to share.
All right, I hope that at some point you will. But just off the cuff, do you like the price at which it is right now?
It is difficult for me to comment, This is, I don't want to be speculative on this, Manu.
Welcome back. The conversations continue here in Davos. We are speaking with global leaders as well as those focused on India, on what the year ahead looks like in terms of investments, deals, and of course, exit options. Joining me now is Kedar Capital's Manish Kejriwal. Manish, always a pleasure. Many thanks for joining us here in Davos. We were just having a conversation with Rishi Kapoor, the CIO at InvestCorp, and of course, they've been in India only 6 years. You've been around much longer. The investment thesis for 2025, given the macros as well as the micros and how they plan out?
Firstly, great being back, Sharon. Always, and the difference this year, as you know, is with the way we both are dressed. It doesn't feel like Davos. We should be in Mexico. But
I wouldn't go that far.
But on a more serious note, I think as we look at India, the secular growth story remains. Of course, there are going to be challenges off and on, like there is recently with a slowdown of growth. Many factors driving that, such as people buying larger houses after COVID, interest rates going up. That's a double whammy for a guy who buys a house and pays mortgage. EMIs have increased. So the amount of money left to buy everything else is much lesser, etc., etc. But these are cycles. You worry about it if you're a short-term trader. We can't make money in these sort of trends. So we are a believer in the secular story, which has, in the last 10 years, grown even faster. We love those sectors, and we're very vertically focused, and our thinking is very top-down and bottom-up. So we look at it thematically. What do we like in financial services? We've done a lot of lending businesses. Yeah. There's a bit of stress there. We're looking at more non-lending, maybe insurance, maybe asset management. Consumer, it was a very small part of the portfolio earlier. Today, it's actually larger than FIG, partly because of the recent investments we've made. And we've actually stepped up on some of those valuations 4 or 5 years ago. But at today's valuations, I'm a seller in many of those companies. And then the two other sectors, Sharon, is broadly healthcare and pharma as one. And the second is tech and tech services. Given where the world is in terms of valuations, our ability to underwrite any new deals, you have to be really careful on what sort of risk you undertake. So our capability, you need to almost have a zero error. So your due diligence are that much more deeper. They always were deep.
Yeah.
But your ability to make a mistake is even more curtailed given the valuations you're coming in at. So essentially, in the current thing, you do both always as a private equity guy, but you're more on balance a seller than a buyer.
So sitting on the fence at this point in time?
No, not at all. Not at all. I'm not saying sitting on the fence. I'm saying the amount of resources we have, which is a large team now, what do you deploy on new investments versus what do you deploy in terms of making sure you get your exits, whether it's through an IPO or through exits. So absolutely not sitting on the fence, being very thoughtful on where we want to invest and so in terms of exits, we're shooting all barrels. We've already had a couple of successful IPOs. We have a couple more coming up this year. On new investments, we're just being very thoughtful. Given the valuations, what risk do we want to underwrite?
Sure.
But we've still deployed close to $700 million in the last 18 months. So it's not that we're keeping quiet or on the fences.
Well, speaking about the IPOs and, of course, Vishal Mega Mart, that was the big one for you. What, realized and unrealized gains north of $1.5 billion? I mean, did that take you by surprise?
You're understating it, but I'm glad you are. We'd rather not be known for that. No, listen, this was If I look at it from a 4-year window, definitely a surprise. I think when we came in, the valuations were about $1 billion, give or take a bit. We've taken a majority control along with the partners group. This was at that time probably the most expensive deal and the largest check we were ever to write. So it was a big risk to undertake. The guys who led this, both Anant and Nishant, did a phenomenal job getting the deal on the table. But should we undertake, and we were buying it from TPG, which is not, it wasn't any other normal deal. We took it on. We had a superb management team under GK. It's grown phenomenally, both same-store growth, and we've increased the footprint all over the country. What was surprising in retrospect, we were scared to pay an NT multiple of 15 or 16 times EBITDA. I don't even want to see where it's trading at right now. It's scary, right? So I think the growth, revenue and EBITDA was very well done by the team, and we drove it to that level. The other side of it, which we'll never complain about, the multiple expansion, who would have thought in 2018? But yes, the last 18 months as we were preparing for the IPO, it was no surprise, right? Of course, we're thrilled where we are. We've only sold about 20% of our holding because we are the promoter. But I think the market is aware that, like we did in Navas, over 3 or 4, we still see significant growth. So all we can underwrite is revenue and EBITDA growth. What multiples do tomorrow, I don't know. But at current multiples, I mean, it's going to take some money off the table and be distant.
So
eventually,
you are looking at that, taking more money off the table?
Not now, but I'm saying eventually, I keep reminding our friends and our people inside, this is not our money. We're a fiduciary, very humbly, of some of the most respected global investors. Our job is to make sure we deploy that in a manner, on a risk-adjusted basis, we give them returns for which more than compensate them for the India risk, emerging market risk, and liquidity risk. So we're looking for a 25% return. And we have to keep remembering that. So we have to remember, no matter what our personal perspectives are, this is not a deal you can fall in love with. Eventually, you need to sell it and give the money back to who it belongs.
Well, speaking of falling in love with deals, anything at this point in time that has caught the attention?
No, I think a lot. I think, again, if I look at it sectorally, the couple of things we're looking at, some in the on a balance sheet side also, but a lot of it, as I said, which is non-fund-based financial services companies. 2 very exciting consumer companies which are making use of the consumer tech. But, we're not early stage. We're much later stage. So sort of a defined business model. But the risk we're taking is, how is the world going to move given AI and all the other great stuff? And then in tech and tech services, what we've done, Sharon, we've been a bit slower on that sector, even though we've had someone like a Pramod Bhasin since our very inception. That, I think, we've given where relative valuations are, we put a ton of focus. We've just taken out, and I've spoken to Rashad about this in previous Davos, we took on a guy called Abid, who was the ex-CEO of Wipro. Outstanding guy. We've added on 1 or 2 other individuals as operating advisors in the US. That deal flow has gone to the roof, and the valuations are much more realistic. So you may not have got, but again, we did just last week announced a $350 million deal, control deal again, in the tech services space, where it's a great company, US-India corridor, doing both data migration and AI implementation. So again, willing to take the bets, but the level of conviction has to be that much higher. We always up relative, we spend a lot of time. It's taken 6 to 8 months to get there. But this company we're in love with. And anyone that we see crossing the threshold, especially today on where the risk is, given the valuations, we'll be in love with those. But again, not to get emotive, so we will have to sell the bride at some time.
I would imagine, and that's part of what you do, Manish. But, you talked about valuations and how valuations are looking better. But on the IT services side, relatively better. But
not historically to IT services.
Sure, but this AI bet, and I mean, anything linked to AI, even remotely, the valuation skyrocketing there. Is that a space that you're looking at as part of this?
So we did do something, but remember, if I just step back and make it simple for our viewers, what we go after in situations like AI is not the gold mine. It's more the shovels that help make the gold mines. What I'm saying is, I don't claim to understand, despite sitting in 20 seconds, on taking a bet on a product. Because I really think in AI, the incumbents have a huge advantage. So we were with Rob Smith yesterday, who runs Vista, in our governor's meeting for investors. He has 89 companies. They're all, I mean, these guys are massive. Or a Microsoft or a Meta. They can deploy this, the capital. They know the customer side.
Yeah.
We can't invest in those. We're investing in startups. Firstly, capital. I mean, you'll get the amount of money going after this, you're going to get drowned. Second, promoter risk. Are these the right guys you want to back? I really believe the money will be made by the incumbents. I think a lot of the money going towards startups, it's a bit like the dot-com age. It blew up in 2000. Are we in 95 or 98? I don't know. But I can see 2000 coming. Value will be made. But you've got to make the right bet. And if we're not, this is very early stage. If we're not in that, we can't pretend to jump onto that bandwagon. What would we rather do? Is work around companies which offer that as a service, not try to build a product, which is what I mean by the shovels.
Sure.
Same thing we did when we started Kadara. Consumer companies were really expensive. We got the confidence to do Vishal 3 or 4 years later. But remember, the first 2 deals we did were both proxies to the consumer space. So we did Parsons Packaging, which made boxes. We did Manjushri, which made but these were proxies for growth in consumer expenditure. So while Unilever at that time was trading at 40 times EBITDA, we bought these companies at single times EBITDA. So, you know, we've got to be, and it's not that we expect a single EBITDA to go to 40 times. It'll remain, hopefully it'll be a little bit higher. But the problem in investing in very high multiples in a faddish environment with AI is, as there's a correction in those multiples, no level of growth, which is what we undertake. We can't undertake the market. No amount of growth, both revenue, top line, and EBITDA, can ever compensate you for a deal you've overpaid for. So that's the situation.
So 2025 likely to continue to be a seller's market?
You know, I think the first half would definitely be that way. But, you know, our team, and you know me well enough, Srini, to know that I'm normally understated. The team that we've built up in the last 2 years, second to none in the country today. We've managed to now attract talent from the global majors. Our last 3 hires, a senior person at Apex, EQT, and Goldman PI. Normally people lose, the local firms lose talent. We've been attracting the talent. We now have 2 co-heads for every sector. And each of them are amongst the best around the industry. So the pipeline today has never looked stronger. It's just the overlay of risk control. Look at it as 20 deals in the pipeline where there used to be 4 or 5. The bar is the same in terms of quality. It's a little bit higher because of relative valuations. So I think the question is, I have no way of knowing how many, and because we raised the $1.75 billion fund last year, we're sitting on a huge amount of capital base, so that's not an issue. So the trick, and also we don't want to be pressurized to deploy capital when we're not ready to. So I think of these pipeline, which is the biggest it's ever been, the question is, as the IC and as you overlay risk on top of it, what will go through the funnel? There's no way of knowing. But I would hope at least 2 or 3 deals and maybe some more evaluations correct, which is, I mean, you'll know that better. You know the public markets better than I do, Sharon.
Well, Manish, it's been an absolute pleasure. Appreciate you joining us here in Davos. We wish you the very best of luck with the year ahead and with the deals that you hope will end up being inked in 2025. Thanks very much for joining us here on CNBC-TV18. Well, with that, it is time for us to wrap up this CNBC-TV18 conversation. We will, of course, continue to bring you more views and insights from Davos. Quick break and back in a moment with more. Stay tuned.
Welcome back. It's still steady as far as the market is concerned. 90 points higher on the Nifty, and the mid-cap index continues to sit with a gain of almost 2% right now. So it's a good day for the broader markets. Top gainers, some of the excitement in mid-cap IT is actually rubbing off on large-cap names as well. Look at Wipro for that matter. Wipro is the top Nifty gainer right now, gain of about 3.5% on that stock. There's Tech Mahindra, which is keeping it company. So looking good overall. And there's a bit of a consumer play, both discretionary and staples. Consumer stocks like Britannia, Trent, then Eicher Motors and Hero, if you consider them an extension of consumer, they're also doing well. So not too bad. Screen is looking good. And with that, it's curtains on this edition of Halftime Report. Thank you very much for watching. Stay tuned. Business Lunch takes the action forward.